Hi, welcome to the discussion on the tutorial 3 for Financial Economics 1. Today we'll take a look at 4 different questions related to how securities are traded. So for question number 1, we have a company called IFN Berhad, which has just sold 100,000 shares in an IPO. The underwriter's cut out of that amount was 70,000 ringgits, and the offering price for the shares was $50, 50 ringgits per share. So the entire IPO's value would be 100,000 shares times 50 ringgits equals 5 million ringgits. But immediately upon issuing the shares, the price had jumped to 53 ringgits per share. So given these set of facts, what is your best guess as to the total cost of the IPO for IFN? And secondly, is the entire cost of the underwriting a source of profit to the underwriters? So for the first part, what is exactly the total cost of the equity issue? The explicit cost here is, of course, the advisory services that the company has to pay to the investment banks, the underwriters, which has been set at 70K. So that is fixed. That is the explicit cost. But there's also an implied cost, which is the underpricing in an IPO. So underpricing happens essentially when the price at which the shares are issued are not the price that the market pays for that stock. So in our case, the share was issued at 50 ringgits a pop, and then from the primary market, when the company got listed into the exchange and was traded in the secondary market, let's say at the end of the first trading day, the share price jumped to 53. So there was a 3 ringgits of appreciation. So in a sense, from the company's perspective, this is telling them that, well, investors are willing to pay 53 for this. So why didn't we issue the IPO at 53? We could have, we should have, and maybe we would have raised that if the underwriters were helpful enough or more skillful enough. So this extra amount that they were not able to raise capital is an implicit cost for the company, which is contained in the underpricing amount. So the amount that the company raised was 5 million, but the amount that they could have raised if they floated the shares at 53 ringgits per share would have been 5.3 million. So the implicit cost of the IPO or the underpricing cost would be the difference of 300,000 ringgits. So to recap, the explicit fees are 70K, and the implicit fee or the implicit cost is 300K. So for the second portion, is the entire cost of the underwriting a source of profit to the underwriters? Well, no, not quite. There's a yes and no associated with it. The cost of the underwriting is a profit to the underwriters. That is true, but it's not necessarily the entire amount. The underwriter potentially also loses out because of the underpricing. That is because oftentimes their fees, the services that they provide and whatever they charge for that is usually, oftentimes, based on a percentage commission basis. So the higher the amount of price that they are able to market the IPO, or the bigger the size of the IPO, they get a bigger cut. So by not being able to float this company's share at $53, they are also potentially losing out because of the underpricing. Now, this is pretty similar to what the textbook has provided you with the kind of explanation available in your textbook. But in addition to that, I would also like to draw your attention to a well-known fact within the financial industry. There are 2 kinds of underpricing. One is ex ante, and the other one is ex post. So ex ante is a Latin term which is forward-looking, kind of predicting, kind of forecasting, anticipating in advance. And ex post is after whatever happened has already happened. So ex post here is the realized or the real value of the underpricing. But ex ante is anticipating in advance. And it is usually the ex-ante underpricing that the investment banks and the underwriters have to account for. And by that, I mean that when they're trying to float a share to the common public, they have to estimate or they have to try and guess how much the market is willing to pay, and then strategically lower the amount. So let's say they believe that the company will trade at 60 ringgits per share, but then they will try to offer that for 50, 55. Because if you don't give the investors or the traders an incentive to make another round of profit on top of that, nobody's going to buy at the exact accurate price. Because if the fair value is 60 ringgits and you buy that for 60, what is your incentive? You're not going to make any money at all. So some kind of a strategic ex-ante underpricing has to go through. And again, this is an implicit cost, both for the underwriter, because they lose out on the advisory fees, and also an implicit cost for the issuer because they have no choice but to forego that extra amount that they could have raised. So this explanation covers for question number 1. Now we move on to question number 2. This is related to market microstructure, specifically the bid and asking. There's no spread here, just a bid and ask. So we've been given a table here. There's a stock called Fintech Berhad. The best bidding price, bidding quotation is 55.25, and the best asking price is 55.5. So there are 4 scenarios. First of all, suppose that you've submitted an order to your broker to buy at a market price. So this is a market order. At what rate will your trade be executed? Well, this is a buy order, so we have to buy at whatever the best asking price is. So the seller with the lowest amount that he or she is offering or asking is the 55.5. So if we buy at a market rate, we have to buy the shares at 55.50 cents. On the contrary, if the order is for a market sell order, the best rate that we can sell at is the bidding price, which is 55.25. So if we have to buy, we buy at the higher rate. If we sell, we have to sell at the lower rate, as the common wisdom goes. So these two are pretty straightforward. Now, suppose that instead of a market order, we go for a limit order, and the order is for selling the shares at 55.62. What will happen? Well, if you take a look at this table, there is no 55.62. So first of all, what we need to understand is this quotation does not match, we are selling, so it has to match the bidding price. There is nobody bidding to buy at 55.62. So this trade order will not be fulfilled. Instead, what will happen is it will stand back in the queue behind all these people who are asking in the seller's queue, waiting for a time when this trade might be executed, meaning that waiting for a time when the market price would change in such a way that new buyers will come in willing to pay 55.62. So I've chalked up here a hypothetical example of this. So this is a short version of the order book given in the question, and this is my imaginary version. So our limit sell order is for 55.62. So beyond 55.5, there are probably going to be people at 55.56, 57, 61, and this is us. We are standing in queue at 55.62. If all of these trades before us, if all of them are executed, only then we have a hope of our trade being fulfilled. So to recap, this is what will happen. The trade will not automatically execute. It will wait for a time when the market price changes for this to execute. But of course, there's absolutely no guarantee that this will be eventually executed. What if the price keeps going down, meaning that the share may never sell? So that's a chance that you have to take with limit order. If you want certainty of execution, you have to go for the market order. Okay, so for point number D, On the flip side, we have a limit buy order at 55.37. Similar thing for the best bid and best ask. 55.37 is not here. There's no one we're trying to buy here. There's no one willing to sell at 55.37, so the trade will not execute. However, unlike point number C, something interesting will happen in here because the best bidding offer is 55.25, meaning there's currently no one in the market willing to pay more for these shares. Now we are trying to buy at 55.37. So that means that we will actually jump the queue and we will go at the top. So previously, this guy right here, he was the best bid to buy the shares. But now we have superseded them. We have overtaken them, and we are at the top of the queue to buy the shares. Now, this does not mean that the trade will be executed because there's nobody willing to sell at this rate yet, but it just means that we will be on the front line and we will stand the best chance of anybody else to get those shares. So that covers the microstructure portion of this tutorial. Next, we move on to a margin position.